On today's episode, we are going to take a look at the top 5 clouding companies. And I'm here to create a list to see which one is the most expensive out of the 5 and which one is the cheapest out of the 5. The 5 companies we are going to take a look at today are going to be Amazon, Microsoft, Google, IBM, and Alibaba. And for this valuation, we're going to actually take a look at 2 valuations. First, I'm going to take a look at current valuation, but I also want to take a look at their future valuation. You might be like, Jose, how are you going to do this? So I'm actually going to take a look at the following metrics. I'm going to take a look at their current revenue growth. I'm going to take a look at their current profit margins, their current sales, and items around, and many more metrics. And when I take a look at future valuations, I have actually gone and taken a look at a lot of analysts and gotten their future estimation growth in revenue, their future earnings growth as well. And this would help me do the similar valuation method based on future numbers. And the way this type of information can help me, this list, I'm going to prioritize. I'm going to be able to see which one is the cheapest at the moment and which one is the most expensive. So if I want to increase my overall exposure to the clouding market, and if you guys have been watching my video, I do have a video of my full portfolio and how I break down that portfolio. So make sure to check that out. Right now it's a small portfolio sitting at a little bit over $40,000. And I do believe about 20% of it is in the clouding market. So with this list, it can help me see which one I find to be the cheapest among the 5. And if I want to increase my exposure in the clouding market, that would most likely be the one I want to prioritize with. And again, it just gives me an overall sense of how the clouding market is doing as well. And right, just like many of my viewers, I do not have unlimited funds. I put money in the market on a weekly basis, and that money in the market, I want it to go to work right away. Right, there's so many studies, and the best expression to be is not about timing the market, it's more about time in the market. So yes, there might be some weeks where I might buy these companies that are a bit higher and they might be overvalued to what some might say, but that's okay with me, right? I'm more of a dollar cost averaging. So even some of my positions, when I enter on a weekly basis, to some it might seem like a small amount entering. But over time, as I add to my positions, those positions start to increase. So today's episode is going to be broken down into 4 parts. So the first part, we're going to take a look at the 5 companies and just take a look at their overall market gains in the past 6 months. Then I'm going to talk a bit about the valuation. And I have done 2 episodes like this already where I took a look at the top SaaS companies and I took a look at evaluating FANG stocks. There is a bit of change of how I'm doing that valuation compared to those previous 2 videos. So if you have watched those videos, I still recommend watching that portion. The third part, I'm going to take a look at current valuation. And finally, I'm going to take a look at future valuation. And I'm going to talk a bit about my thoughts in there. So let's get started. And before we begin, if you are new to my channel, if you are a long-term investor, and if you want to learn about growth stocks, make sure to hit that subscribe button. And to all my returning viewers, I always want to thank you guys for all the support. It really means a lot to me. Make sure to hit that thumbs up. It helps the small channel out so much. And just let me know in the comments, who do you guys think is actually going to be the cheapest out of all of them and who's might be the most expensive? Right now, remember I said we're going to take a look at Amazon. We're going to take a look at Microsoft, Google, IBM, and Alibaba. If you guys ever want to get in contact with me, I am very active in the YouTube comments. I also have a Twitter channel, which I'm very active. And I do have a Discord, which is free to anybody that wants to join. We have a lot of great investors in there, a lot of great minds to just overall bounce ideas. But remember, all of this is free. I am not a professional. None of this is advice. And everything here is just my opinions. So make sure to talk to your financial advisor before doing the risk of investing in stocks. And finally, if you guys want to join my weekly newsletter, make sure to check out josenaharo.com. I am sending one on a weekly basis. And the Excel format that I'm going to be using here will be starting to be sent out in those newsletters. So make sure to subscribe there. Just check out josenaharo.com. And I do have a lot of more information there. So like I mentioned, today we're going to take a look at 5 stocks. And I want to, the way I looked at this is I wanted to see who are the top 5 leading dogs, top dogs in this position. And right now, Amazon in Q4 of 2019 was the leader, holding 33% of the overall clouding market. Next is Microsoft holding 18%. Then is Google at 8%. IBM, it comes in at 4th at 6%, and Alibaba is the 5th, coming at 5% of the overall market. So first, let's take a look at Amazon's price performance in the past 6 months. Amazon has returned about 56% to investors. But remember, Amazon is not only in the clouding business, it is also in the e-commerce business that has been doing amazing during this whole mess that we're going through in the world with this whole pandemic happening. Next, let's take a look at Microsoft. Microsoft in the past 6 months has returned about 22% to the overall market. Google, on the other hand, has not returned positive results. Actually, it has. It has returned 2.3%, so it's pretty much flat for the past 6 months. IBM in the past 6 months has actually seen a decrease of about 10%. And finally, BABA has given investors about 11% to returns. So obviously, we can see the big boy right now is Amazon giving 55%. So you might be like, hey, Amazon is definitely going to be the most expensive out of all of them. But don't be so sure about that. I did do a kind of a video with FANG. So some of these were actually already hit. But I still think this cloudy market business is pretty good to definitely take a look at them. All right, so now let's take a look at this valuation. So first, we're going to take a look at current valuation. And let me just explain to you how I have this Excel sheet. First, on my first column, I have the companies and their names. So like I mentioned, IBM, ticker IBM, Amazon, ticker AMZN, Google, ticker GOOGL, Alibaba, ticker ABABA, Microsoft, ticker MSFT. On the second column, I have trailing 12 months revenue growth. So this is pretty much how much the revenue growth has grown in the past 12 months. Then this is what's mainly different about my current valuations. Nor in the past 2 episodes, and like I mentioned, in the past 2 episodes, I took a look at FANG stocks, and then I also took a look at the top SaaS companies, which were CrowdStrike, Fastly, Zoom. What else did I take? Adobe, Okta, and Zscaler were the 6 I took a look at. So if you guys want to check them out, I definitely recommend taking a look after this episode. And there I was actually taking a look at current price to sales ratio. So if you guys don't know, current price to sales ratio is the current market cap divided by the current trailing 12 months revenue. So for example, if a business has a market cap of 10 billion and it has revenue of trailing 12 months of 1 billion, it has a current price to sales ratio of 10. And the reason I was using, so right, these are just portions what I'm going to take a look at, and it's going to lead me to my future valuation. So it's not like I'm using the current price to sales ratio to give me that valuation. I take a look at this, and later on I put them into, I mix them with another valuation to help me look at different formats. But the thing about current price to sales ratio is there is a better method, and this method is called EV to sales. So that's enterprise value to sales ratio. So first, let me explain to you guys what the enterprise value is. So the enterprise value is the current market cap of the company plus the total debt minus the current any current cash or cash equivalents. So for example, if a company that has more debt is going to have a higher enterprise value. And the reason why you're saying, hey, why are we adding money into that business and making the enterprise value higher? And remember, this is enterprise value divided by sales. So the higher the numerator, and if sales remains the same, it's actually going to increase that metric. It's going to increase that valuation. And the higher the valuation, the more expensive. So we're making sure we're counting their debt, and we're also counting their current quick cash. So let me just explain that to you guys again. Current enterprise value is the current market cap plus debt minus quick cash. So actually, if you have no debt and you have a lot of cash, it's actually going to bring down your enterprise value. So when you divide it by sales, it's actually going to even give you a better number. So here we're actually taking a look at their debt and any quick assets that they do. So this is the biggest change that I've done since my previous videos. Then I'm taking a look at their trailing 12 profit margins. That's very self-explanatory. So now let's just right now take a look at their current enterprise value. So if we put them in order, right now, the cheapest out of all of them is IBM. And the most expensive out of all of them is Microsoft. And let's just do some type of thinking to understand why IBM might be cheaper, is cheaper than all of them, and why Microsoft might be the most expensive. And here we can see the IBM at the moment is the cheapest, but IBM is also the one with the slowest revenue growth, where all of them, Amazon, Google, BABA, and Microsoft, are growing at a crazy levels in revenue growth. IBM actually saw a revenue decline. So obviously I would pay a lot less for a business that's not giving me positive revenue growth than a business that's actually giving me a lot of revenue growth. The other thing is Microsoft, out of all of them, is actually the one with the highest profit margins. So out of all its sales, Microsoft is the one that's keeping most of its money. So to me, it's completely understandable why Microsoft is expensive. But again, because it is expensive, it might give me a chance to say, hey, Jose, maybe if you wanna get into the clouding market exposure, let's take a look at some other metrics to really help us understand how they're valued. So one thing is, I don't want to just use the current enterprise value to sales ratio because it misses out a lot of information. So remember, the enterprise value only cares about the market cap, the debt, the assets, and the total revenues. But it doesn't take in place the profit margin growth, and it doesn't take in place the revenue growth. And that's actually a lot of information that's being missed out. So then there's a second valuation. There's the rule of 40. The rule of 40 is pretty much this valuation that's used to kind of categorize SaaS companies. But here I'm gonna use the rule of 40 because they take a look at revenue growth and they take a look at profit margins. So the rule of 40 is pretty much add the total revenue growth plus the total profit margins, and it gives you a value. So over here, we can see the one that has the least amount of revenue growth and least amount of profit margins is actually IBM. So again, this continues to give you a reason why IBM might be cheaper than all the other ones. And if I take a look at, let's just take a look at the revenue growth. I actually want to see who is growing the fastest. The one growing the fastest right now is BABA, growing in the past 12 months. It grew 35%. Then we have Amazon grow 22%, Google grew 17%, Microsoft grew 13%, and IBM actually decreased about 3%. BABA, the one that is the fastest growing, is actually the second most expensive, which kind of I was actually a little bit surprised there, but I remember BABA is also a business that's international, and they are pretty much Chinese headquarters. So investors take that added risk, and that added risk of having an international company can sometimes bring down the total value. So investors would obviously, it does seem like investors are feel more comfortable paying a premium for Microsoft than going to BABA, just because there is that added risk of that international risk, and it makes sense. If you believe it is safer to invest in America, then you're most likely gonna go and invest in these companies, and it would actually drag down the price of overall international companies because there are more risks there. The other thing I want to show is BABA has the second highest profit margins out of them all. Microsoft was the one leading the pack with 33% of profit margins in the past 12 months, where BABA was not that far behind at 29.3%. We have Google at 20.7, IBM 11.8, and Amazon at 3.6. All right, so first, like I mentioned, we took a look at the current EV to sales ratio. And there, the current EV to sales ratio mentions the enterprise value, which has the market cap, has the total debt, and has current assets and the current revenue. But it doesn't take in account the profit margins or the revenue growth. Where the rule of 40 takes in account the revenue growth and the profit margins, but it doesn't take in account the current market cap or the current debt or the current assets, or even the revenue. And now by having these two valuations together, I can kind of see everything in one picture. I'm going to be able to see their current valuation. I'm gonna get to see their current enterprise value, their current revenue, their profit margins, and their revenue growth. So it kind of shows me a little bit of everything. All right, so now that I talked about the evaluation process, let's just take a look at their current valuation. So what I end up doing is this current enterprise value per sales divided by the rule of 40. And that's going to give me some form of value. This value is the current valuation. The lower the value, the cheapest it is compared to the rest. The higher the value, the more expensive. So let's put them in order from smallest to largest. Right now, the cheapest out of all of them is BABA. And that to me is pretty impressive because one, BABA did have the highest revenue growth in this past trailing 12 months. And it also had one of the highest profit margins. But again, remember, Alibaba is an international company, so there is that added risk there that many investors see. And that's usually a reason why sometimes Chinese companies or even international companies are valued a lot cheaper than American companies. And we're seeing that here. Even though BABA is showing amazing revenue growth, is showing amazing profit margins, it's still considered the cheapest out of all of them. Second in place is, so BABA's value is 0.14. Next, we're going to take a look at Google. So Google is not that much more expensive than Alibaba. It actually has a valuation number of 0.147. So very, very minimal increase there. And next, we're going to take a look at Amazon. Amazon is 0.19. And actually, let's take a look at what their current valuation means. So all right, so now we can, like I said, I wanted to actually show how much more expensive they were from each other. So if BABA is the cheapest, let's use BABA as the baseline for all of them. So BABA has a ratio of 1. Google has a ratio of 1.04. So it's not that much expensive compared to BABA. Amazon has a 1.37 valuation. Again, it's not even double the price of BABA. So it's not that crazily overvalued. To me, it's not that much. It's about 37% more expensive than BABA. Next, we have Microsoft. Microsoft now is about 62% more expensive than BABA. Now we're starting to get a little bit in there in the valuation. So now Microsoft, like I mentioned, does seem to be a bit expensive compared to everything else. But now let's take a look at IBM. IBM, based on current numbers, is showing to be almost 3 times more expensive than BABA. And that to me tells me, hey, maybe IBM would be one to hold off for the moment. But me being more of a growth investor, and I do believe the market is more of a future valuation method, it doesn't really care about the current valuation. It cares more about future valuation. So now we're going to take a look at their future valuation and let's see if things end up changing. All right, so the future valuation, I'm going to take, let me just explain the columns again for you guys. So there are a few different ones. So here in the first one, I have, again, the companies we're going to take a look at. On the second column, we have expected revenue growth. And you might be like, Jose, what kind of fortune teller magic do you have that you're telling me what their expected revenue growth is? Obviously, there's so I don't have any crystal ball, but there are analysts that kind of give us what a company is expected to make at the end of this year and what a company is estimated to make next year. So it takes to find that revenue growth. I used estimation of 2021 and revenue estimations of what they're gonna end this year. So that gives me that expected revenue growth. Then I'm taking a look at, so that with that revenue and the revenue for 2021, I can calculate the forward enterprise value to sales. The enterprise value doesn't end up changing. The only thing that ends up changing is the sales, and that's the value, the revenue that's expected to be made in 2021. Next, I need to find out their profit margins. So what kind of profit margins are they going to be seeing at the end of 2021? So about 2 years from now. And again, the way I'm calculating that is I'm using the 2021 estimated revenue as well as the 2021 estimated earnings. So now I can see what kind of profit margins they're expected to make. And then after that, we pretty much have everything to get our forward enterprise value to sales ratio. We have everything to get our rule of 40, and we get everything to get our current valuation. So let's take a look at expected revenue growth. Right now, in expected revenue growth, let's actually put it from smallest to largest. IBM, to no surprise, is the one that's expected to grow the slowest. It's by the end of 2021 compared to at the end of 2020, it's only expected to grow its revenue about 2.5%. The biggest is BABA, growing at 25.6, and then the second fastest is Google at 20.25, Amazon at 17.6%, and Microsoft at 10.95. So we can see BABA and Google are really expected to grow their revenue from the end of 2020 to the end of 2021. So now we can see the one that's the cheapest based on forward enterprise value to sales ratio is IBM. But remember that we don't really care much about this forward enterprise value to sales because it doesn't tell us everything. So now if we take a look at the profit margins, I want to see if anything has changed in the profit margins. If we take a look at them, we can see Microsoft is still leading the pack with the highest profit margins of about 30% for the end of 2021. BABA is there at 20%. Google is there at 18.54. IBM is stepping up at 12.11. And Amazon is expected to have a profit margins of 4.78. And even though it's 4.78, that is a huge increase compared to their 3% profit margins this past year. So now let's take a look at this new valuation and see how they compare. So if we compare it from smallest to largest, the one with the smallest valuation, so in theory, the one with the cheapest valuation is Google. And now let's take a look. Where last time it was BABA, let's now take a look at how it's different. So this time we're going to use Google as our baseline. So we're going to do this divided by, and let me just show you guys how the current rankings were compared to current valuation. So in current valuation, BABA was number one. This time, Google was number one. But remember, the difference between Google and BABA were almost negligible. And here's the same thing. Even though Google is now number one and BABA is number two, their price difference in valuation has not really much changed. BABA is only 2% more expensive than Google. So if you're paying $1 for Google, you're only paying $1.02 for BABA. So not much of a big difference. And actually, that's I'm liking that way that shows. So if you're paying $1 for Google, you're going to be paying $1.02 for BABA. You're going to be paying $1.29 for IBM. You're going to be paying $1.39 for Amazon. And for Microsoft, you're almost paying $2. So the most expensive at the moment is Microsoft. And this is pretty cool. IBM was the one that was the most expensive based on current valuation. But based on future evaluation, and remember, in future valuation, we're taking a look at their future expected revenue growth. We're taking a look at their future profit margins as well. And IBM jumps all the way up to number 3. And that to me, actually, now it's like, hey, Jose, if you want to get into the clouding market, the 3 you should probably take a look at right now, based on valuation, are Google, BABA, and IBM. Amazon is actually not that far off from IBM. Where for IBM, you're paying $1.29 compared to Google. For Amazon, you're paying $1.39. A little bit higher, but when you take a look at it, it's not even 50%. It's a 39. It's not even 40% higher. So again, this valuation takes kind of in effect everything. So it helps me understand who I should focus on. And I am pretty impressed that BABA is that cheap compared to everything else. Again, I understand that risk that's coming from there. And to me, I'm shocked that Microsoft is that expensive. I already have a healthy position in Microsoft, so that's good for me. It tells me, hey, maybe right now hold off on Microsoft. And also remember, this is a very volatile market. So what could be cheap today, tomorrow can actually see the most expensive can see a huge decrease in price and can make it the cheapest. So and again, it's not saying that Microsoft is a bad value. It's not worth that, right? Is Microsoft worth that $2 compared to Google being that $1? That's not something I can say, but to me, I'm already taking a look at their profit margins. I'm already taking a look at their estimated revenue growth. So it kind of really puts in line who is the cheapest amongst them, taking a look at everything in its place. And remember, with the volatile market, all of this can change on almost a daily basis. So whatever could be expensive today could be the cheapest tomorrow. And with me having my working capital coming on a weekly basis, it can help me focus. Hey, maybe this week, if I want to add into my clouding exposure, Google, ALIBABA, maybe IBM, or maybe even Amazon might still be a great choice. Maybe hold off into Microsoft. But again, this doesn't tell me, hey, Jose, go sell off Microsoft right now, because these valuations can just continue to go up and up. To me, it's just helping me reduce my risk by overpaying on the most expensive. It's helping me buy the ones that's the cheapest compared to all of them. So I hope you guys enjoyed today's episode. Like always, make sure to hit a thumbs up. Make sure to let me know what you guys thought. This is episode number 3. Are you guys liking this video series, or do you guys want me to cut off? Maybe I can do them on a weekly or maybe twice a week basis. I do have a lot of other series that I take a look at. For example, Monday is going to be Monday Matches, where I take a look at 2 companies and put them against each other. So let me know, are you guys really enjoying these series? Take care, guys. Have a good night and see you next time.